Very good morning to all. Standard 11 Commerce, Subject OCM and chapter number 8, that is Source of Finance, our continued chapter. First of all, let me discuss about what is source of finance, characteristics, importance, and thereafter that we learn about two types of source of finance. Number one, that is owner's fund, second one is borrowed fund. Owner's fund, three types is there: equity share, preference share and retail earning. In borrowed fund, various types is there: debenture, loan, thereafter that various commercial bank, institutional, those who are provide loan, okay, then public deposit, bond. So these all are borrowed fund is there. In this particular topic, most important two sources that we have to discuss over here. Number one, that is trade credit. Our next topic, that is trade credit, and second one, that is internal corporate deposit. Okay, so this topic that we have to cover in this particular lecture, and the last topic of this chapter, that is the difference between owner's fund as well as borrowed fund. So two topics that we have to cover over here, and we have to complete our topic and chapter. Okay, so let us start. Borrowed fund, various sources of borrowed fund that we have to discuss over here, and in that particular topic, important two topic is there, subtopic is there. Number one, that is trade credit. Number two, that is internal corporate deposit. So let us start trade credit. So what do we mean by trade credit? The word itself told that trade credit given by traders. Okay, let's see. Business unit have need of raw material, finished goods or other tools and things. In this situation, a business unit purchase from other products or traders on credit of some time period and create working capital. Okay, so whatever we are purchasing raw material and other goods from the creditors, from the sellers, that if we are purchasing two types, okay, number one on the basis of cash and number two on the basis of credit. So if we are purchasing that things with credit, so we are giving some time period to repayment that money. Okay, so in this way, by purchasing goods and services, goods mostly on credit, we can create our working capital. Okay, so this is again borrowed because we are purchase that on the basis of credit. So this is the most important thing, that on the basis of credit we are purchasing raw material and finished goods from the creditors. Next one, thus the creditors do not have capital directly, but they giving goods or services on credit and they satisfy the capital requirement. See, creditors are not there, those who are giving directly capital to us. But what they are giving? They are giving goods, raw material, which is useful for us. And that's why it is again source of finance. Because directly or indirectly, they are giving us to capital. Not in a directly capital, but they are giving raw material, okay, and other goods or machinery which is useful to develop our business. So this is the trade credit, and now last, internal corporate deposit. Okay, let's see. Usually when a company gives deposit to other company which is in need of fund, such deposit is called intercorporate deposit. Okay, so simple, you can say that one company give loan to other company. Okay, so one company is giving loan to other company. That we can call it is a internal corporate deposit. One corporate giving loan to other corporate. Okay. Next one, usually those type of transactions occur between a major company and minor company. Also happens between various companies managed by one group. Okay, various companies managed by one group. For example, Reliance. So Reliance have many types of business. deposit. Okay. Next one. Rate of interest and time limit is decided by an arrangement as compared with the other source. This borrowing is very easy because internally we have to exchange the money. So without any documentation, without any mortgage of our assets, we can receive the money from the market. Okay. So this is the borrowing fund. Many topics are there: debenture, bond, then public deposit, thereafter long-term institutes, commercial bank, trade credit, internal corporate deposit. So various sources is that one organization or one company, those who are collect money from the market. So this is the borrowed fund. Now whatever we learn, two important topic, that is source of finance. Number one, that is owner's fund, and number two, that is borrowed fund. So now we have to see the difference between owner's fund as well as borrowed fund. Okay. So five topics is there. Number one, that is meaning. Okay. So number one, meaning. So what do you mean by owner's fund? Let's see. Funds invested by shareholders is called owner's fund. So whatever fund which is invested by owners, that is called owner's fund. Where borrowed fund, the fund borrowed from the other source and invested in our business. Okay, it means that the fund collect from other way and invested in our business, that is called borrowed fund. So this is the meaning. Number two, source. Okay, so number two, that is sources. So let's see, can be received from equity share, plugging back of profit, depreciation fund, and reserve. So owner's fund, there are three sources: equity share, preference share, and plugging back of profit. In plugging back of profit, all the reserves that are included, because reserve is also one part of profit. Okay, and what are the borrowed fund sources that we already discussed? Debentures, bond, public deposit, long-term institute, commercial bank, trade credit, and internal corporate deposit. Okay, let's see. Can be received from debenture, commercial bank, and financial institutions. Okay, so this is topic number two, that is sources. Number three, return. Okay, so here return. So let us see where we have to return our owner's fund at the end of business. Rate of return is from dividend of the owner's fund. So what is the return of owner's fund? Dividend. Okay. And what is the return of borrowed fund? Interest. Okay. Let's see. Return is from the interest at a fixed rate. Debenture, fixed rate. Bank loan, fixed rate. Loan from institutional, fixed rate. Okay, so here in return, fixed. Owner's fund, what is the return? Dividend. Borrowed fund, what is the return? Interest. Okay. Number four, rate of return. Okay, so here that is rate of return. So here, as we discussed in owner's fund, rate of return is not fixed. If higher the profit, higher the dividend. Lower the profit, lower the dividend. In certain cases of loss, no dividend. Okay. But here in borrowed fund, the rate of interest is fixed. Let's see. Rate of return is uncertain or not fixed. While here in borrowed fund, rate of interest is fixed. And last, number five, repayment of capital. Okay. So here repayment of capital. So here again it is discussed in meaning characteristics also, that repayment of capital is done first to borrowed fund and then after owner's fund. Okay, so here let's see, repayment of capital, owner's fund is repaid at last. Okay, how it is calculation I will show in our calculations. Okay, and last, repayment of borrowed fund is made earlier than owner's fund. So whatever profit is there, that they are invested, first of all, that they are repayment to borrowed fund, and then they are So this is the difference between owner's fund and borrowed fund. 5 topics is there. Number 1, meaning. Number 2, sources. Number 3, return. Number 4, rate of return. And number 5, that is repayment of capital. Okay. And now company are repayment or company are doing work. Let's see. So how we can calculate that I am seeing with the help of board. Okay. So here that calculations now we are going to see how we can see. Okay. So with the help of board. Okay. So let's see how the company is there. Those who are doing calculations. See, as we know that company are received fund from the sales. So first of all, sales is there. Okay, sales. Okay, in sales, first of all, they are paying variable cost. Okay, so when they are paying variable cost, the remaining is called contribution. Okay, contribution. See, this is the topic of finance. When you learn in higher studies, okay, it is repeated. Okay, in the chapter of leverage, it will be useful. Okay, how they are paying expenses as well as dividend. So first of all, instead of what is the income of business? Sales. In sales, first of all, they are paying variable cost. Whatever remaining is there, it is contribution. Then they are paying fixed cost. Okay, so fixed cost. Okay, whatever it is remaining, that is called EBIT. Okay, that is called EBIT. What is the full form of EBIT? Earning before interest and tax. Listen carefully, and after that, our lecture I have already sent the video after some time. What do you mean by EBIT? Earning before interest and tax. Then after that, first of all, they are paying interest. What they are paying? Interest. Interest of loan, interest of debenture. Okay. Then interest loan taken from. In short, interest which is paid of borrowed fund. Okay. Whatever borrowed fund that they are taken from the government or other institutes, they are paying interest. Whatever remaining amount is called EBT. Okay, in EBIT, interest is paid out. So what is remaining? EBT, interest earning before tax. Earning before tax. Then they are paying tax. Okay, and that's why we are included or we are discussing that before the paying tax, that they are paying interest, and that's why interest is tax free. Okay, interest is tax free. So here that they are paying tax. Whatever remaining amount is there, EBT instead of EBT, now it is EAT. What is the full form of EAT? Earning after tax. After the payment of tax, what is earning? That is over here. Now that they are paying preference share dividend. What they are paying? Preference share dividend. Okay. So preference share dividend that they are paid. Now whatever remaining is there, now important it is called earning available for equity share holder. Listen carefully. Earning available for equity share holder. And now here in all the things we are deducting, but here final amount is there. So here we are dividing number of share. Which share? Equity. Because as we know, equity share is a true owner of company. So whatever earning is there, that we have divided by number of equity share. And whatever answer that we have, it is called EPS. It is called EPS. What is the full form of EPS? Earning per share. Okay, so mostly corporate, they are divided their earning in this type. Okay, revise one more time. First of all, sales. Instead of sales, they are dividing variable cost. That you already learned in economics. What is variable cost? It is on the depend on production increase. Production increases, variable cost increase. Production decrease, variable cost decrease. Production zero, variable cost zero. Then after whatever remaining is the contribution. In contribution, they are divided or they are subtracts of fixed cost, which is fixed. Depreciation, salary, whatever. Okay. Whatever remaining is there is called earning before interest and tax. Then they are minus interest of borrowing fund. Whatever remaining is there, EBT, earning before tax. Then they are paying tax. Whatever remaining is called EAT, earning after tax. And after that particular fund, they are paying preference share dividend. And whatever final balance is called earning available for equity share holder, and it is divided by number of share equity, that is equity share. And whatever earning is called EPS, earning per share, which we can also call dividend. Okay, dividend of equity share holder. Okay, so this is the whole scenario. Very important table is there. Even if your friend or relative, those who are studying in college, okay, you can ask. You can check the knowledge of you or your friends or relatives. Okay, guarantee. One question that you have to should be asked: how company divided their profit? What you have to ask? How company can divide their profit? ગુજરાતીમાં કહે તો પૂછવાનું કે કંપની પોતાની ઇન્કમ કેવી રીતે વહેંચે? બસ આવું કે પૂછવું જવાનું. એટલે ચક્રમ ખાતા થઈ જશે. અને આવા તો બધા બહુ પોઈન્ટ્સ છે. પછી તમારા ટચમાં નહીં આયા એટલે. Okay? So this is all about sharing of their income. Okay? Thank you so much. This is completion of chapter number 8. On next part, on next lecture, we will discuss chapter number 9 and onwards. Okay? Thank you so much. Be there. Continue.